The next review talks about how proprietary trading firms control the risks of high-speed trading. So proprietary trading firms are firms that trade their own capital and their own money in the markets. So what can these firms do to minimize the impact or the losses from these algorithms and high frequency traders that are there in the market? So let's understand some new trading strategies, and we'll begin by understanding the life cycle of a new strategy for any proprietary trading platform. So these firms trade for their own accounts using their own capital. The firms normally do not have customers. They will trade on public exchanges and alternative trading systems like electronic communication networks and dark pools. So most of these trading firms trade multiple asset classes like fixed income, equities, futures, options in one or more geographic regions. So some have a presence on the exchange trading floors, that is, they are co-located. Some clear their own trades, that is, there are also clearing members of the exchanges, and other use other clearing members to clear their trades. 9 firms were interviewed, 9 proprietary trading firms, and all accessed the market directly via proprietary trading platforms, although some firms purchase platforms and software only to use as a backup, but actually they trade through the clearing members. But most of them did have their own trading platforms, and they execute their trades using their own high frequency algorithms to generate profits. So the firms who execute these trades through these computers or algorithms can be fully automated, that is pre-programmed trades. There is no human intervention, a black box. A computer tells you what to buy, what to sell, and everything is in the hands of the computer. That is, the firm trusts the computer and the strategy that the computer has input into the computer. So it's a complete black box trading. Other strategies could be fully automated, but with some trader discretion to modify the algorithm. So it's called a gray box. So some human intervention in the trades and in the algorithm is allowed. So there are several steps in the life cycle of a new high frequency trading strategy or an algorithmic trading strategy. So first is you develop a new trading strategy. That is, traders and trading groups will work with software developers and IT staff to translate trading ideas into a source code or into a computer program. Most firms have traders that also program. So this code is then turned into executable programs. The strategy is then back-tested. That is, simulate trading environments used for backtesting. Simulated environments for backtesting are again built in-house or are provided by a trading venue or third-party providers. So they will see how this strategy would have worked in the past, analyze the results of the backtests. So if the strategy is determined as not economically viable, then it is modified and retested, or it is terminated. If the strategy appears viable, then it is tested in the market in small quantities, and some risk limits are generally set before the strategy is executed in the market. Analyze the results of this small trading, and again, if the results from the actual trading are not viable, then you modify the strategy and backtest again, or if it appears viable, then you move on to the next step. That is, set the risk limits and actually employ the strategy in your proprietary trading. That is, firm sets the risk limits, writes the hard code limits in the source code, and begin full trading using this strategy. So there's a formal approval process required to move a strategy from the testing stage to the production stage. Traders, system administrator, chief investment officer, chief information officer, risk manager, risk management team, all play an important role in approving the new strategies. Then the changes to the code, risk parameters, login credentials, etc. are logged and are periodically reviewed. And that is how a high frequency trading or an algorithm gets into creation and execution and then comes into the market. So remember, 2% of those firms that constituted 70% of the volumes in 2009. That's what these firms do. That's what these proprietary trading firms do to develop newer trading strategies or high frequency strategies. So within these firms, what is the risk management structure and what is the role of risk platforms? So in the previous 3 presentations, we studied what the exchanges can do, what other market participants can do, what low frequency traders can do in order to avoid the impact or losses from these high frequency trades. Now we are studying that what can these high frequency traders themselves do, or these proprietary firms that employ these algorithms and high frequency strategies, what can they themselves do so that the risk is minimized and they don't cause losses for themselves and for others, rather unwanted losses or rogue behavior by these algorithms. So the risk management operations will differ across firms. Some firms have traders and a risk staff reporting to a single risk management officer. At other firms, there is no firm-wide risk manager. Instead, every trading desk will have its own risk manager. Some large firms will have a risk management group at a central location. So firms will typically build their own risk platforms, although some will purchase other platforms to use as a verification of their own proprietary platforms. So these platforms will check all trades before routing them to exchanges and other trading venues. They work in real time for electronic trades. So firms can use a value at risk measure or standardized portfolio analysis of risk or some other parameter to estimate the exposure. Some use proprietary algorithms to estimate the profits and losses and the amount of the exposure. So risk models will use the data compiled by the trading firms, purchased from the vendors and or purchased from different venues. The data can sometimes be corrupt, so firms need to cross-check these results to identify mistakes and outliers. So what we find is that in some cases the firms are at times not even able to calculate the risk. So they are not able to calculate the firm-wide portfolio risk because of unavailability of data or because of the complicated nature of the trades or the speed of trading, etc. So the risk management platform, as we understand, is pretty standard. This is how you would see a risk management platform in a general institution or in a mutual fund or in any other fund as well. But what we're trying to highlight is that yes, even these proprietary firms or these high frequency traders will have some risk management tools at their disposal so as to help them. So a lot of times trading limits are set on the platform. That is, how much can a trader trade, how much can a desk trade, how much can a group of people trade, how much can one location trade, how much money can be devoted to a particular product, to a particular strategy, and at an overall firm level, what is the limit on the risk that the firm can take. The CEO and the management team will review these risk limits, normally reviewed daily and sometimes on a monthly or a quarterly basis. And one firm of those 9 that were interviewed said that the traders who make the most money sometimes get higher risk limits than traders who make less money or who cause losses. So when risk limits are breached, the trading platform may send the trader an alert, send an alert to risk managers, stop the trading, liquidate the trades, or require the traders to take opposite positions in order to reduce the risk or reduce the limit that has been breached. So we studied the pre and post trade controls employed by exchanges, but what are these, or what can the firms do to reduce the risk? So pre-trade risk controls will typically tend to warn a firm when an order is approaching a risk limit. Once a limit is breached, controls may suspend order entry. Limits may require traders to take opposite positions, as we studied if they're breached. If an out of control algorithm or erroneous trade is detected, then the trade may be stopped before being transmitted. Corrupt data, hardware or software failures, programming errors, other factors may cause an algorithm to mess up. So these things also need to be checked as a part of the pre-trade risk control. Exchanges also set pre-trade risk limits, as we studied. So these limits may be the last lines of defense if a firm's pre-trade risk controls are weak or non-existent. So firms with unfiltered sponsored access that we studied, which are able to directly access the market without any pre-trade risk controls, will be dependent on the exchange's risk controls or trade limits that can prevent rogue trades or prevent trading errors, as we studied in the previous slides. That is, clearing members may have the authority, or the exchange itself may have an authority on certain orders and certain limits. so they can set the limits for their customers or these high frequency traders. So trading firms may set more stringent limits than the exchange normally, and a lot of times these firms will not apply the limits evenly across strategies. So they will often apply fewer checks so as to reduce latency that we studied. And some examples of the risk limits were on maximum size of order, intraday positions, credit limits, price band limits, profit loss limits, limits on the number of orders that can be sent. So very similar to the pre-trade limits that we studied at an exchange level. However, they can also be done first at the firm level so that the situation doesn't escalate to a point where the exchange has to intervene. So if the firm itself has good enough risk controls, then generally the exchange will not need to intervene. Some exchanges set limits on the number of orders that can be sent, as we studied. So one of the firms that was interviewed intended not to trade when there is potentially artificial volume in the market. So it has a volume detecting software. So if it detects that some algorithm is trading or there is some artificial or manipulation happening in the market, then the firm will try to avoid trading during that time. Post-trade risk controls, as the name suggests, come into action or try to control the risk after the trade has been executed or ordered. So firms use information to control risks after the order or after the fact. So drop copies, which include trade reports and messages related to the orders, are provided by the exchanges and other trading venues to the clearing members and high frequency trading. So the content and the timing of these reports can vary, but the firm essentially would want to compare the drop copies with the order that it has put in and ensure that it should be exactly the same. So if I sent a buy $100, then the exchange should also receive a buy $100. If there is some discrepancy, that means there is some error that has happened in the middle. So information may be provided account by account or for the entire firm. It can be in real time or can be at the end of the day. So the drop copies essentially basically are compared with your own trade information so that you can check that yes, the order that has been received by the exchange is exactly the order that you entered or the order that you executed. So again, you can study more examples of what the interviewed firms said about post-trade controls. So various examples mentioned in the curriculum that you can go through. We'd like to highlight that each of the trading firm that was interviewed amongst these 9 firms had a kill button to stop trading in extreme circumstances. So kill buttons are typically manual, and some firms have even developed automatic kill buttons that will stop all trading under certain circumstances. So typically the risk managers, the chief operating officer are authorized to activate these kill buttons. So kill buttons can stop trading at the trader level, at the desk level, at a particular product or strategy, or even at the whole firm level or for an entire location or an entire trading venue. We already studied cancel on disconnect allows a firm to cancel orders when the firm server is disconnected from the exchanges. So the connection is referred to as a heartbeat in the industry, and this may be disconnected due to a network disruption or a system going down, etc. So various ways in which the cancel on disconnect works. For example, if a connection is lost for more than a minute, then the cancel on disconnect can get activated. That is, the orders will get killed, or whatever the agreement is or whatever the risk control is will get activated. So key challenges in the firm's own risk management of high frequency trading, or the proprietary firm's risk management of the algorithms that it's trading with, is first, information on over the counter data is largely unavailable and transparency is an issue. So if you're trading in the OTC market, then that is an additional concern. Trying to replicate events like the flash crash of May 2010 using stress tests is quite challenging. So how do you model and test for a totally unpredicted or unexpected event? So even though you can do some stress testing, etc., but still there will be these unpredictable crashes that can happen. Drop copies need to be in real time. Only then it makes sense, and only then you will be able to do a good post-trade risk control. A lot of exchanges do not provide these drop copies in a timely manner. Proprietary trading firms believe regulators should provide a risk model framework and allow firms to build their own risk management systems based on the framework. They do not believe that regulators should prescribe vendor solutions for managing the risks of sponsored access. So if a firm has a sponsored access or unfiltered sponsored access wherein it can trade without any pre-trade checks so as to enhance speed and reduce latency, then a lot of regulators are asking such firms to follow a framework internally before they can get the unfiltered access or unfiltered sponsored access. So firms believe that the regulators should provide a model framework so that the risks can be hedged and the risk controls can be put in place. Firms believe they understand trading better than the regulators, so they should be able to allow and build their own risk management systems. So best practice documents from the industry are more desirable than regulatory guidance or a regulatory imposition of a particular framework. So rules that they feel should be made more simple and consistent so that trading and risk management can be enhanced. Firms believe that pre-trade risk control should be uniformly applied by trading venues so that there is a level playing field and no one person has faster access just because he has bad risk control. So if I don't have any risk control, obviously I will be able to access the market faster and the latency will be lower for me. So pre-trade risk controls should be uniform so that everybody has the same latency from the risk management perspective. Of course, you can have higher or lower latency because of your algorithm or because of your software or your own skill, but just because of the risk control, there should be no advantage or disadvantage. Operational risks are also a concern, and they should be managed to prevent against rogue traders. We'll study the policies of one of the firms that has instituted the following practices to manage operational risks in its trading. So risk management staff are prohibited from trading. Traders and trading staff do not have access to risk controls or cannot change or lift the risk checks. Risk limits must be checked daily by the heads of each trading desk. Trading and risk management functions are off limits to the accounting staff. Accounting functions are off limits to the treasury staff. Each department reports to the CEO on a daily basis. The head of each trading desk signs a contract stipulating that the head of the trading desk is personally and financially responsible for the losses due to breach in the risk limits. Conversely, if a breach results in a profit instead of a loss, the head of the trading desk is not allowed to share in the gains. So if limits are breached, he will personally be responsible for the loss. But if a profit happens from a breach of limits, then he will not get the gains. So this will just make sure that each of the heads essentially follows the limits and follows the risk management practices. Another firm said that cross-functional meetings to discuss risk are important. So risk managers, traders, developers, legal staff, etc. all discuss risk management issues. Best practice firms reconcile trading activities reports with 3 sources: trading venue, clearing members, internal databases, so as to ensure that there is no mistake that has happened. So more the checks, the easier it will be able to identify any discrepancies or any wrong message that may have gotten inadvertently sent. Clearing members must audit. the risk controls of the proprietary trading firms that access the markets directly. So clearing members are responsible for the integrity and the credit risk in the markets. So these audits often occur when a new relationship is established, but after the initial audit, firms don't conduct the audits frequently enough. So they should still happen at least annually, or even more frequently, so as to ensure that the risk controls are in place with all the clients and all the proprietary trading firms that trade with a particular clearing member. So that's about high frequency trading. So we understand what it means, who uses them, what are the advantages, what are the problems, and what are the guidances on risk management of these strategies from both the regulatory perspective, the exchanges perspective, the low frequency traders perspective, and the high frequency trading firms perspectives themselves. That is the proprietary firms trading perspective themselves, who use the programs. So we'll continue the discussion on current issues in financial markets in the coming slides.